Hey friends, Harvey Keene Properties LLC, West Valley real estate agent. Today I want to talk about mortgage interest rates, since that's been the talk of the town for the last couple of years, and will probably be the talk of the town for years to come. I want to talk about why they're where they are and why people think that 6 to 7% is a high rate, which it isn't. It's a normal rate over the course of history. Why interest rates got so low, which they should have never been, and they stayed pretty low for a while. We all got very spoiled for about 10 years with low interest rates. I'm going to talk about how the secondary mortgage market works, but I'm just going to jump right in. So today, interest rates are 7.08%. That's for the 30-year fixed rate conventional mortgage. Everybody's interest rate when you qualify for a loan, it'll vary slightly depending on credit score, debt to income ratio, program, all that stuff. But the typical average 30-year fixed rate conventional mortgage, with 20% equity, 7.08%. So we're working our way back down towards the sub 7 handle. So when you take out a mortgage, like let's say you refinance your house, or let's say you go buy a home and you use a mortgage to buy your house. Let's just say that the lender that you borrow your money from, let's call them ABC Mortgage. One of the documents that you sign at the closing table is what's called a notice of servicing transfer. And what that is a disclosure telling you that ABC Mortgage will not be the servicer of your loan. They originated your loan, but they're not going to service it. And furthermore, they don't own that note. So they're not the person that actually, they may have been the conduit through which you borrowed that money, but it wasn't their money that they lent. There's a, I guess you call it a market. There's a market. It's called the secondary mortgage market. It's kind of like the bond market, but for mortgage loans. When you take out that note and ABC Mortgage writes that loan, generally that loan is destined to move from that lender to another lender. So usually if you've ever bought a house or refied and you went through a mortgage company, usually within a month or so, maybe 2 months, you're going to get a statement in the mail that basically says your mortgage has been transferred to a new servicer. And let's just call that mortgage servicer, let's just say it's Wells Fargo or Chase or B of A, whoever, whatever. That's the servicer of the loan. And usually, even that servicer isn't who owns the money that you borrowed. So they may collect a fee from the end investor who actually was the person, behind the curtains that lent you that money. Wells Fargo, Chase, B of A, whoever, they get paid a fee to service that note. And who they get paid by is the owner of that note, the person that basically had the capital for you to borrow. And on the secondary mortgage market, the way it works is loans are bundled into portfolios, and they call that securitization. So let's just call it 1,000 loans. So on the secondary mortgage market, and they call them collateralized debt obligations. So those securitized mortgage loan portfolios, let's just call it 1,000 loans. Those are sold on the secondary mortgage market to whoever wants to earn the rate of return on all that money. And During the financial crisis of 2008, some of these big investors that injected a lot of liquidity into that market by basically providing the capital for that money to be lent for borrowers to borrow and buy and sell homes and refinance homes, whatever. A lot of those investors went belly up. There was, I'm not sure if you remember the names Lehman Brothers and Bear Stearns, and then there was a large insurer, private mortgage insurer, AIG. They had a lot of financial troubles, and they were a PMI company, private mortgage insurer. That's a whole different topic for a whole different video, but it sort of weaves into this sort of story in the how mortgages work and why interest rates got so low and why they're back to where they were before. But anyway, before the financial crisis, interest rates were at 6 to 6.5%, which is normal. November 2008, the Federal Treasury, or the Fed, who, by the way, whenever you hear the news talking about the Fed is going to drop rates, that has nothing to do with mortgage rates. That has to do with overnight lending between financial institutions. It's a very short-term thing. And like I discussed on other videos, longer-term bonds are what affect mortgage rates, because mortgage it's a long-term debt, right? So anyway, interest rates before the financial crisis were 6 to 6.5%. And these companies that provided liquidity to the secondary mortgage market, a bunch of them went under. And so all of a sudden there was no liquidity and no way for so I remember in 2008, I remember people showing up to sign their closing papers. They were approved and everything, and it was almost overnight those loans couldn't be funded because those funds were not available. There was like no liquidity in the market. So the federal government and the Treasury, they, as a measure of rescuing the economy, because the economy, they say, was on a total brink of absolute collapse. They were there as a backstop to A, rescue the market, and B, stimulate the economy, economic stimulus packages. I'm sure you remember all that. Part of that was a concept called quantitative easing. And what quantitative easing is when the government or the federal treasury, when they become an investor in the private markets. And what I mean by that is essentially the federal treasury and the government, they start injecting capital into these markets to kind of prop them up because there's not enough private investment in the markets. And those markets are, it's all based on supply and demand. So if there's a lot of demand for investors to buy those securities, mortgage-backed securities, securitized loan portfolios of thousands of loans put together and sold on that secondary mortgage market. If there's a lot of demand from investors, the prices of those bonds goes up and the yields come down. Because if there's a lot of demand, that means there's a healthy appetite for a longer term rate of return, and they see that there's less risk in the future. So if there's less risk and there's higher demand for those assets, interest rates actually come down. So if the government hadn't stepped in, there's a lot of speculation that interest rates would have just went through the roof. The government stepped in as a measure of rescue for the economy and for the mortgage market and the real estate market. So in November of 2008, the federal treasury, they injected like $600 billion into the secondary mortgage market, buying mortgage-backed securities. They did that for about 7 months. And interest rates went from 6.5% all the way down to 4.5% by June of 2010. And they hung out there for a little bit, not long, maybe about 4 or 5 months. Interest rates popped back up over 5. And it was pretty clear that, we were still in a recession, and the economic circumstances were still pretty dicey. So immediately, the Fed injected another in November of 2010. So basically 1 year after quantitative easing 1, we're going to call that QE1, because there's been 4 rounds of quantitative easing since 2008. So we'll call that first round of quantitative easing, we'll call that QE1. So 1 year after QE1 was initiated, they initiated QE2, which is a second round of quantitative easing. So interest rates were back up to 5%. They injected another $600 billion of liquidity into the market. And by the end of June 2011, interest rates came back down to 4%. Market still wasn't recovered yet. There still wasn't a lot of private investment in the secondary mortgage market to provide liquidity and low rates to the markets. So September of 2012, the Fed injected more capital, hundreds of billions of dollars into the secondary mortgage market, buying mortgage-backed securities, and that kept rates between 3.5% and like 4.5% for a while, for like 7 or 8 years. And there's always volatility in markets. So rates, like I said earlier, they're never static. They move around, and so rates may have come up to 4.5%. They may have come back down to 3.5%, but they basically stayed in that realm for like 8 years. Fast forward to QE4. So we had QE1 November 2008, QE2 November 2010, and we had QE3 September 2012. And that basically went on for like 9 or 10 months. And July of 2013, that's when the Fed said, hey, we're going to start tapering our investment in these mortgage-backed securities, and we're going to shut that spigot off for the market. Well, that's okay, because the economy was already recovering, and there was already renewal of private investment in the secondary mortgage market. So interest rates they stayed low for a while, and then 2020. I want to say it was March of 2020. What happened? COVID happened. You remember everything that happened with COVID, and all these trillions of dollars of economic stimulus just got unleashed onto the market. And that was the 4th round of quantitative easing, 2020. So that pushed rates, and I want to say that rates before COVID happened, they got back up to 5% or just under 5%. But the market was healthy. Things were selling. And we were having a normal annual rate of appreciation. After the 2020 injection of liquidity into the market, QE4, that took rates way down during COVID. Like sub 3. Like there were people that were getting 2.75% 30-year mortgages, which is insanity. Like a total anomaly in that market. And what that caused was an asset bubble in the real estate market. Prices, so we had a pretty short inventory market to begin with. Not a lot of homes for sale, but all of a sudden, cheap money just flooded the market with buyers and flooded the market with money. Well, what happens when you have too much credit and too much money chasing too few assets? That's basically the definition of inflation. Too much money, too much credit, chasing too few assets. So we saw like a highly inflationary environment in the real estate market. And here in the Phoenix metro area, we had over the course of a couple of years, we had some properties almost double in value, which is crazy. And that was all well and good until March of 2022. March of 2022 is when Federal Treasury Chairman Jay Powell says, we are not going to be quantitative easing any longer. We're just going to stop. There was basically no taper. They just stopped. So March of 2022, rates basically went from 3% to 5% over the course of 2 months. May of 2022 was when Federal Chair Jay Powell said, not only are we not buying mortgage-backed securities and treasuries any longer, we're going to start selling our balance sheets off into the market to private institutions. So investors, smart investors, they like two things. One, they like a strong rate of return. So let's just call that interest rates. They're earning capital off of their investment. Two, they like buying stuff at a deep discount. They like buying stuff on the cheap. That's what investors do. So you have basically 12 years of the federal treasury investing in the secondary mortgage market, accumulating trillions of dollars of mortgages that the Fed owns, but other institutions are servicing, like your mortgage servicer, B of A, Chase, Wells Fargo, whoever. The Fed actually owns those notes because they were the ones that bought those securities on the secondary mortgage market. So in order for them to actually unload those balance sheets, they had to sell them for a deep discount. They were selling them for like 60 cents on the dollar. So that was May of 2022 when they made that announcement. Like almost instantly, rates went from 5% to like 7%. So you could see why people thought that 7% was so high, because for the better part of 12 years, interest rates were kept artificially low by the federal government buying treasuries and bonds and mortgage-backed securities. And when they stopped buying them, March of 2022, who had to pick up the slack? Private institutions, pension funds, large banks, big investment funds, investment houses, hedge funds, whatever. Well, those institutional investors had a choice. Like, do we buy this 3 to 5% interest rate loan portfolio from the federal government for 60 cents on the dollar? Or do we make premium demands on the secondary mortgage market and the treasuries market and invest in something that gives a better rate of return? So that whole premium demand raised interest rates from essentially 3% to 7% over the course of like 4 months, or 4 to 6 months. Interest rates hit a 24-year high October of 2023. And they've come down since then. They came back down to a 2-year low of 6.1 just this past July of 2024, and the Fed announced in September that they were cutting the federal funds rate by 0.25%. What did interest rates do for mortgages? They actually went up 0.25% from 6.1. And since then, the Fed has cut 2 more times. So from September to the end of the year, they cut a total of 1%. The Fed did on the federal funds rate. So July interest rates were 6.1%, and now they're currently at 7.0%. So essentially, the federal funds rate is down 1%, and we're essentially on mortgage rates up 1%. Figured that one out. Anyway, what market controls interest rates is the mortgage-backed securities market, somebody who's there to provide liquidity, and then also the 10-year Treasury yield. That's kind of what mortgage interest rates track. So if you're following the 10-year Treasury yield and you see, let's say there's a great economic indicator report that comes out, on a Wednesday or whatever, and the bond traders really love that. And you see, like what we saw earlier this week, you see the 10-year Treasury yield come down a lot. Well, you probably won't see the same amount of movement in mortgage interest rates, but you're going to see movement in the same direction. So that's how I knew earlier this week that we were going to see rates come from 7.25 back down to like 7.1, just by watching the 10-year Treasury. Now, what causes the 10-year Treasury to move? Well, the economy. The strength of the U.S. dollar, economic reporting. This past week, it was core inflation that the investors, the bond traders liked. When you see high demand in the market, prices of bonds come up and the interest rates come down. Because when there's demand, there doesn't have to be that rate of return to satisfy the investor appetite. When there's very low demand, there needs to be incentives for liquidity to flow into that market. Interest rates come up. Interestingly, anytime that there's an economic recession, what do we see? We see deflation, right? We see prices come down in a lot of things because demand drops. So interestingly, the dichotomy there is when there's strong demand in the bond market, you see interest rates drop. But also when you see a contraction in the economy and you see a recession, you actually see interest rates drop. Because interest rates kind of follows inflation as well as it follows positive economic reporting. It's a strange dichotomy. Pretty much every recession that the United States has had, you would see that mortgage interest rates actually drop as a consequence of that. And then, funny enough, shortly after or during a recession is actually when you see sort of a rally in the real estate market. I'm not sure the explanation of that. That's just what happens. So where do we go from here? With a new administration in office, with new sort of economic policies, both domestic and foreign, trade, Trump and his tariffs and whatever his trade policies are going to be with other nations. Who knows? I see an argument that rates could go back over 8% again. I tend to be an optimist. I think that we'll probably see interest rates, throughout 2025. I think they're going to fluctuate between 6.5% and 7.5% back and forth with volatility. I think they're going to move violently back and forth, meaning You're going to have a really good day where interest rates might come down like 20 basis points, and you're going to have really crappy days where they shoot up 0.25%. I think that they could come back down to the low sixes, maybe even sub six very temporarily, but I think they'll shoot right back up. Just like they did July to September to today. We're basically 1% higher than we were during the summertime. So I don't think, because the federal treasury has, they've telegraphed that they do not intend to enter another phase of quantitative easing. So I don't think that we're going to see the government intervention in the markets to artificially suppress rates back down to the 3, 4, 5% range. Maybe they get into the fives if the economy is just like really robust and there's a lot of appetite for the bond market, for the bond traders and the big investors. Maybe they get back into the fives. My guess is they're probably going to spend a lot of time in the sixes and low sevens. And that's historically normal. That's not a high rate. Honestly, the federal government probably shouldn't have gotten involved in the free market. They should have kind of let things play out. It would have involved a lot of pain, but I think our economy would be healthier right now as a result of that. Remember, inflation. Too much money, too much credit, chasing too few goods and services. So not only did we see that during COVID in the real estate market, everybody knows what groceries look like right now. And vehicles, with the whole microchip, the computer chip shortage, supply chain issues that they had. New car prices got totally out of control because supply and demand, there weren't a whole lot of them. And as a consequence, what happened to used car prices? I'm sure everybody remembers selling a freaking 2-year-old car with 30,000 miles for essentially the cost of a new one. Those days are over. So I think so long as some crazy black swan economic event doesn't happen, I think that we're going to just be back to the old normal. The old normal will be the new normal. That period of 2012 to 2022 of crazy low interest rates, I think it's a thing of the past. I think we all need to accept that and understand it for what it was. It was artificial. And I think that we need to work with what we got. And sellers, you need to be willing to be flexible. Not maybe so much probably on price, but on terms. So like 9 out of 10 deals are closing right now with seller concessions to buyers for closing costs. A lot of those concessions are going to buy down interest rates. That's one way that we can work through this on the listing and selling side of the real estate equation, is understanding that prices have not corrected to the extent that interest rates have come up. So it hasn't been a commensurate exchange in real estate prices coming down while interest rates are coming up. So affordability is tight right now for a lot of home buyers. And fortunately for a lot of sellers still have a lot of equity because home prices haven't corrected that much. So a lot of sellers have a lot of equity to use as a down payment to go elsewhere. And even if you as a seller, if you're giving concessions to a buyer for closing cost concessions, you still have a lot of equity remaining to transfer into another property, where that seller may give you closing cost concessions to buy down your interest rates. So the component to, like, if you're in the if the prevailing market rate is in the mid sixes, you might be able to, with concessions and interest rate buy downs, you might be able to buy that down to sub 6. So that's one way to look at it. There's a lot of creative ways that you can look at buying and selling homes right now and make it work. Anyway, I think I've covered what I wanted to cover. It might have been a little bit scattered. I wanted to sort of give a crash course on the secondary mortgage market, quantitative easing, quantitative tightening is what happened in March of, or I'm sorry, May of 2022. Quantitative tightening is where the government starts unloading their balance sheets into the private market at a discount. Covered inflation. Yeah, anyway, it's a long video. Hopefully I provided a little bit of informative content. If I was too scattered or all over the place and whatever I said was difficult to understand, leave me a comment, send me a message, whatever. If you have specific questions regarding you and your scenario, thinking about buying or selling, entering the market as a consumer in some way, shape, or form, please call me, 602-295-0890. Once again, my name is Harvey Keene, Keene Properties, LLC, West Valley real estate agent. I serve the entire valley, but my focus is West Valley. Goodyear, Buckeye, Avondale, Litchfield Park, Glendale, Peoria, Surprise, Tolleson, Greater Southwest Valley, Greater West Valley. Anyway, thank you for watching. Let me know if you have any questions. Have a great day.